Hello and welcome to the weekly roundup for the week ending Friday the 12th of March. Hope that you enjoy these weekly reports. Do subscribe to receive regular stock market content. Any questions you've got, pop them in the comments box below. Love to hear from you, love to hear the feedback. And again, I invite you just to follow our free stock market reports, tech stocks, bank stocks, IPOs, and anything that's current and on the tip of investors' tongues, really. So this week, the US $1.9 trillion stimulus package, inflation expectations and bond yields. That's really been the central driving forces for the markets. At the start of the week, the rising bond yields unnerved investors, sending stocks lower and the US dollar northwards. Then midweek, we just saw a bit of respite. Weaker than expected core US inflation combined with a couple of successful US bond auctions reined in inflation expectations and calmed the bond market, boosting stocks. President Biden also signed off on the largest US stimulus bill in history. That happened on Thursday, and that sent US stocks to fresh record highs. However, today, on the back of that fiscal stimulus, the inflation expectations are rising. And interesting to note, the US 10-year yields are once again back above that 1.6%, just taking a little bit of edge off the demand for the stocks. Overall, been a pretty decent week for equities. FTSE's managed to show 1.3% increase across the week. The DAX gained 4% and actually hit a fresh record high. The Dow Jones also hit fresh record highs and is on track for a 3% increase through the week. S&P 500 set to book gains in the region of 2%. And the Nasdaq, 2%, even if you take into account the futures that are pointing negative today. In the FX markets, the US dollar index hit multi-month highs at the start of the week on surging bond yields before easing lower. It's set to show a decline across the week of 0.1%. The ECB met this week and, as expected, kept rates on hold. The central bank also reaffirmed its pandemic emergency purchase programme and said it would remain at 1.85 trillion euros until March 2020. It did also announce that it would front-load purchases, accelerating the buying of bonds in Q2 in response to the rising yields. So euro against the dollar trades pretty much flat on the week. Pound against the dollar trades up 0.5% across the week, with the latest data revealing the UK economy contracted less than expected of 2.9% in January. So shifting focus over to the commodity markets, oil trades almost flat on the week. We did see a fair amount of volatility though. Prices spiked at the start of the week following an attack on a Saudi Arabian oil facility. So Brent actually shot through $70 a barrel, and the WTI crude hit a 2-year high. But then prices quickly corrected before recovering again on US stimulus optimism and expectations of a quick recovery in demand. If you'll pardon the pun, gold is really losing its shine at the moment. It's on track for mild losses this week, 4th straight week of gold being in the red. Several factors, most notably the rising bond yields, make the non-yielding gold much less attractive as a safe haven. Add this to the stronger US dollar, and that puts pressure on the dollar-denominated commodity as well. Into the stocks, there's been some notable performers. Rolls-Royce, I mean, this was a week that we found out exactly how bad 2020 was for Rolls-Royce. The aircraft engine maker reported a large and expected loss of £3.96 billion in 2020 due to the grounded planes, versus 583 million profit in 2019. Still, the share price didn't take the hit that people might have expected. The outlook was more optimistic than maybe people expected. Flying time is expected to rise to 55% of that of 2019 this year. And overall, they've gained nearly 5% across the week. Royal Mail, phenomenal week really, trading almost 10% up. They upwardly revised their revenue forecast by 900 million on last year, while pre-tax profit is expected to be around 700 million compared to the 25 million a year ago. The cost of restructuring is also looking to come in at 90 million versus the planned 140 million. So the stock itself is trading at a 2.5-year high, a clear beneficiary of the pandemic and the rise of online shopping. Burberry has also surged 12% this week, thanks in part to stronger than expected Q4. Bounce back in sales in Asia means it now expects full year revenue and adjusted operating profit to be ahead of forecasts. The stock is now trading at pre-pandemic levels. So that's it for this week. Thank you very much for watching. As I said, remember to subscribe. Any stock or anything that you might want to hear about specifically, again, let me know. Have a great weekend and take care.